Hi again, everyone. Hope you had a great summer, and welcome to our latest market report. Dion Zukiwsky, branch manager and director here at Scotia Wealth, back in the saddle with you, and we're going to check out the latest and greatest in the investment world. Today, we're going to look at a few topics. One we'll call Summer Love, the September Sucker Punch, and Strategy, all beginning with the letter S, which is purely coincidental. All right, so like a teenager having his first summer crush, investors were loving the markets the past few months as well. Investment indexes had a few minor bumps, but for the most part, continued to make new all-time highs. This was from the ongoing global recovery that saw pent-up consumer and corporate demand, rising corporate balance sheets, all injected with low interest rates to keep that juice flowing. In our Zook Group models, we also saw impressive gains in other areas as well, such as alternatives and private equity. However, similar to that teenager crush, as we head into fall, the big question is, will it last? Well, what we need to look at is, will things keep rolling along, or are we headed for what we call a September sucker punch? Okay, a few things to consider. First is seasonality. Typically in the stock markets, September does not have a lot of positive history on its side. Since 1950, the average return for September in the US markets is actually a negative 0.5%. Should this matter this year? I would say no. We're certainly not in normal circumstances, so we won't even qualify this as a normal risk. Then, there's the boogeyman of COVID and the latest Delta variant. Looking at the following chart, we can see the different waves of new cases and COVID-related deaths since the outbreak. And what we're checking out here is COVID started in a major way in roughly February and March of 2020. That would be wave 1. Wave 2 came later that fall. Wave 3 was earlier this year and into the spring. A little bit of calmness throughout the summer, which was of course great. And now we're seeing a bit of rise in cases again. So with this in mind, will it become enough of an issue to cause another major disruption in the economy? The answer here is a strong unlikely. Vaccination rates continue to rise, plus central banks and governments around the world now have somewhat of a playbook to fall back on. And one of the big moves in this playbook was to place borrowing costs at super low rates with super low interest rates. Personally, I think this could be more of a moderate risk to the investment world, because if inflation becomes a big enough headache, then central banks such as the Bank of Canada will be forced to raise rates to help cool off the economy. As of this past Wednesday, we heard from the latest announcement from the Bank of Canada that they are keeping rates at these low levels for now. Scotia economists predict that in December 2022, we may see a chance of rates rising. Right now, there's about a 55% chance of that happening. Now, these rate moves will be predicated on the labor market, as mentioned, also inflation. A few months ago, inflation was making all of the headlines, with everything from lumber to gasoline really zooming higher. And we discussed that in our last video as well. However, that overall rate has been simmering down. And even more interesting, when you break down what actually is causing this inflation, it is concentrated in a few specific areas. And our friends at Scotia's Global Portfolio Advisory Group will show us more in this chart. And what we're checking out here is what's called a disproportionate effect from select goods that are having a bigger impact in that inflation number. The colored bars show the different parts of the economy, and these include things such as airfare, food, and most recently, used car prices. Trust me, as a dad who recently helped out my older son get an upgraded car for his college days, used cars is definitely a seller's market, not a buyer's market. So from this information, we could list inflation and interest rates as more of a moderate risk for markets going forward. And oh yes, there's something with a federal election happening too. Scotia won't allow me to provide a big opinion on that. After all, this is a family show, folks. But realistically, we don't feel the federal election should have a material impact on markets going forward. But this is something we can check out in our next video. So with all this information, what should we do about strategy? When we take all these previous factors, mix them up in the old Zook Group soup pot, what do you get? Well, we believe the strategy recipe is quite simply more of the same. Our Scotia strategists, and we would agree, state that there's going to be some short and possible medium-term volatility coming up. This is normal, but long-term, markets still look quite robust. For portfolio models, we're going to continue to have a growth tilt, and this will include careful monitoring over the next few quarters. And if there is any major disruptions, we'll be ready to act. And we'll leave that for today. We'll wrap up our report. Please give us a call or email anytime, and thanks for watching.